It's Brian Preston, the money guy.
Improve your credit score.
Now, this one I thought is funny because I don't actually know anyone who's ever had this New Year's resolution, but it came up as one of the most popular ones. It's one of those ones that people are like, you know what? Maybe I made some mistakes in my prior life. Maybe I wasn't as responsible early on, but I've been listening to this Money Guy show for a while, and I know that not only is the credit score something that will allow me to go get good rates, but it might even save me money on things like my auto insurance and that sort of thing. So I bet there are people out there who think, I want to improve this. How do I do it?
I think it's probably more of a broad reaching. They're not thinking credit score and just like, man, I need things to be better. I need to be able to, when I go to the bank, I could actually borrow money, or I need to be where when I go turn on my utility bill, they're not going to make me have a deposit because my credit score is better. So here's the things. I think it's important if we showed you a slide and actually went through what are the important things you need to pay attention to if you just want to overall improve what's your credit score, what financial institutions are basically making decisions off of you on.
So the big thing you need to recognize is there are 5 things that affect your credit score, and we're going to list them in order of how much they affect it. So the biggest thing that affects how good your credit score is your payment history. Plain and simply, do you pay your bills on time? This is an important one. It makes up 35% of your score. So you want to make sure if you do have credit card payments or auto loan payments or mortgage payments or fill in the blank, you're paying your bills on time, because even just one late payment can ding your credit score. So that's a big one.
And ding it in a big way, because this is the biggest one.
That's exactly right. Then 30% is your credit utilization. What this says is, of your available credit, how much are you utilizing? So if you have a $10,000 available credit balance, are you using $1,000 of it, or are you using $9,999 of it? The bigger that spread is, the bigger that margin is, the better your credit utilization.
Now, I want to share a story, self-deprecating, but hopefully you guys learn from it. I don't know if I should share it, because eventually you guys are going to be like, why would we listen to this guy? If he's this knuckleheaded, there's no way this guy's an expert.
Wisdom comes from experience. That's
exactly
a Brian Preston
right. So here's the thing. When my wife and I were buying our first house together, I thought it'd be brilliant because I knew that we were going to be applying for a mortgage. And I was like, you know what will impress these mortgage companies when they go see my credit is if they see that Brian only has access to $5,000 worth of credit, because they were going to be like, man, this guy, he makes this much money. His wife makes this much money.
He doesn't need to borrow anything.
All that money is going to be available to go to their house payment. So this is going to be no problem. So I actually called all my credit card companies, like the 2, and I said, hey, I know I have a $10,000 credit limit on there. Can you take it down to $2,500?
And the credit card was like, wait, what? You want to go down?
Yeah,
we don't normally get that phone
They don't
call.
give you education on these calls because they did it. They actually did it. Well, it screwed up my credit rating because now from the credit utilization, it looked like, because even though I'm paying it off monthly, if you're paying it off and there's $1,000 on the account, when I lowered everything down to $4,000, it looked like I was using a 25% utilization, which is a lot different than a 10% utilization. If I'd have kept it at the $10,000, I screwed up, all because I was trying to window dress. And this is why it's important. Nobody teaches you this stuff. So somebody who's already thinking like a financial mutant like me, I stepped into a huge mistake just because I thought I didn't understand how the system worked.
Now, here's my opinion on this, and I've not actually fact-checked this, so this is just going to be a Boism that I'm going to share with you. Does this mean that you should go out on every single one of your credit cards and raise the limit to the largest extent possible? Absolutely not. Have a healthy limit on your available credit. Don't use it all. But at some point, at least I have found this, no matter what income does or no matter what trajectory does, I'm not increasing how much my available credit is. I know how much I actually use, and I know where my thing is. I don't need to keep expanding that.
That doesn't mean they're not. I mean, every year, every time, like I've told you, every time I go into my credit cards right now, they're asking me to update my income.
Yep, every time.
And I'm like, nope. I'm just, remind me later, because I know that they want to expand how much the credit is. Pay attention to that stuff.
Absolutely. So then the next part is 15% of your credit score is made up of your length of credit history. Now, this is one, unfortunately, you cannot go back in time and open up credit cards. But if you're someone who opened up that student credit card in college, but you don't use it anymore and you're thinking, you know what, I really just want to shut that down, Don't do it, because you want your first established credit to stay on there forever. Now, all the credit cards you open since then, or all the credit lines you open up since then, can close, but you want to have a long length of credit history because it makes up about 15% of your credit score.
Here's another money guy hack of this isn't, I got right. So let me brag on this one, is that my first credit card, you guys know I love Disney, right? It was not a Disney credit card. It was actually a Six Flags credit card, because I used to love going to amusement parks. So why wouldn't my first credit card ever be a Six Flags credit card, so I get those extra points and get free tickets to the park? The problem is, as I got older, I realized not really going to Six Flags anymore, so I'm not going there as much. I'd like to get out of this credit card, but it was my earliest credit card. I couldn't close it because that would totally screw up my credit history, because that was my longest length of credit. So what I did was, here's the cool thing, and here's the hack. Most credit cards now are like 5 banks. I mean, have you not noticed how many? Chase,
all the big ones.
Capital One. I mean, they're all kind of the same banks offering different versions of different credit cards. You can actually call your credit card company, and as long as it's the same family bank, they can change your credit card to a different benefits program. So that's what happened to me. I turned by that time, the banks had all merged up, that my Six Flags had turned into like a Chase card. The Chase, I was able, or First National, whatever it was at the time, turned into a complete rewards type card. You can do this. So take advantage of that. Instead of closing that account, there might be a way, if you just call the bank, that they can change you over to a sister or sibling account that will serve you better.
Another little hack to think about is if you do have children that are getting ready to fly the nest, so you have those kids in college, perhaps it's a good idea to go ahead and help them open a credit card in their name that they use for one purpose. Maybe it's putting gas in their automobile, or maybe it's going out to eat once a month or whatever. If you go ahead and establish that now, when they do graduate and it's time to buy their first car or buy their first home, they'll already have some credit history established. Now, make sure you educate your child on how to responsibly use credit. They don't get themselves into a mess, because you'd rather them learn that under your tutelage than learn it the hard way by screwing it up a whole lot. But that's something you can do for your kids in college.
So what I just heard, analogy-wise, is you want to have the birds and bees discussion while they're in the house about credit cards versus let them learn it on the street.
Yep, that's exactly what I just said.
That's kind of a good analogy, because that is a very smart way of looking at it.
10% is types of credit. This is just you have secured debt or unsecured debt, secured being like a home mortgage, unsecured being like credit card. And then the last 10% is how often are you inquiring for new debt? How often are you opening up new credit cards, opening up new lines? If you're getting close to a major purchase like buying a car, buying a house, don't go open up a bunch of credit cards, and don't try to go open up a bunch of store credit to be able to furnish the house. You're going to end up hurting your credit score.
And then I'll just close. This is not part of your credit score, but it's living in the same family tree. Is, by the way, there's more crooks. If you're now at the level of success that you're not opening up credit cards, you've already got your mortgage, you're in a good place financially. Consider freezing your credit card.
Oh, yeah.
I mean, your credit rating and your credit score, because it's 3 credit bureaus. You can freeze it so easily on the internet these days, because there's more crooks trying to use your credit than likely you're trying to use your credit. So it's just great peace of mind. So consider looking into the details on that.
Love it.